Shane, thanks for spending some time with me. We've got a lot going on at the moment, market volatility, clients' fund values are down, we're getting a lot of concerned clients on the phone, face-to-face meetings we're having. I wanted to grab some time with you just to put some of the clients' questions and concerns to you. Obviously it's Tuesday today, the vote is tonight as well in Parliament, so this will affect some of the answers, some of the talks that we have. Main concern with a lot of clients is around Brexit. So is the recent volatility just down to Brexit, and if not, then what?
It is and it isn't. I think generally it's political uncertainty globally, but for UK investors, obviously Brexit is first and foremost in their minds. We've gone the last couple of months where Theresa May came up with her first plan, and every step of the way has been knocked back by members of Parliament, which is a bit disappointing. But that's the way it is, and I think the market here has taken on board as much of the bad news and uncertainty as it possibly can. So the full expectation is tonight that it's going to be declined, and Theresa May is going to have to come back on Monday with a plan B. So sort of the curveball here is if it gets passed. So there's an argument really that as we sit today, there's probably only upside in the market if we get the deal passed through, but it's unlikely. I would imagine it's completely already priced into the marketplace. But the volatility we've seen overall, particularly compared to 2017, which is one of the most benign years we've ever had, is sort of trying to get back some sort of mean reversion on what volatility should look like. But it hasn't helped with a lot of political uncertainty. So Europe in particular, you've got Emmanuel Macron under a lot of pressure with his Gilets jaunes movement. You've got Italians, they put their coalition together, but the budget looks completely stretched. So that sort of is pulling Europe aside, where you've got all these different countries under one regime. One regime might favour Germany, but it's obviously suffering in Italy, and Greece is going through issues as well, where there's a vote of no confidence apparently going to happen for the Greek government. And you've got in May the elections for the members of the European Parliament as well. So there's a lot of uncertainty going around. And then not to mention obviously the uncertainty globally with the US and China with their ongoing trade wars. The deferral of the increase in tariffs has been put back, and there's been good murmurings been coming out from the talks between President Xi and President Trump. So we hope that's going to help. But obviously, the flip side of some good murmurings coming from China and US is America itself is in a bit of a conundrum with the Democrats now in control of the House. They've stymied on releasing their budget numbers, and we've had the US government shutdown. So that's in its longest period ever historically for a government shutdown, and that's having a massive effect. It's about $2 billion a week is wiped off GDP. That's going to have effect the longer it goes on. Okay, 2/3 of the government are still open, but there's certain departments that still need these people in, and there's certain data not coming through, particularly for the farmers. So you talk about the US and the China trade wars, but farmers don't know how much soybeans are being bought by China, which is one of the massive important parts on there. And Miami have just announced as well, Miami Airport, that they're going to start closing terminals early because they can't get enough of the TSA staff in at the moment, because they've said we're not going to work for free, which is completely understandable. So there was a lot to worry about last year. There's a lot to worry about this year as well, and all that uncertainty is increasing the volatility. And when you would compare it back to 2017, it looks a lot higher than it was. Is it at the height that we were for the global financial crisis? No, but it's a lot higher than it was a couple of years ago.
You touched on the global financial crisis. We've often said we've been here before.
Yeah.
Does this remind you a lot of the build up to the global financial crisis? Are there similarities? Are there many differences? Should we be concerned?
Yes. One of my favourite sayings, Mark Twain, history doesn't repeat itself, but it often rhymes. And there are definitely echoes of 2007, 2008 happening now. Does that mean we're going to have a recession on our hands immediately? No. Does it mean the risk of a recession has increased? Yes. There's a lot of data points, and we read a lot of strategy and summary and data that says the recession is more imminent than it has been previously. Part of us goes, well, that's common sense, because in March, the economic recovery, the rally that started in March 2009, will be 10 years old. It's natural that at some stage this will finish. We've certainly become more cautious than we were, say, beginning of last quarter in October. Are we thinking a recession is just around the corner? No. Are we prepared for the portfolios if there is one? Yes. So we've recently reduced our equity exposure, so we're neutral on our equity exposure across the model portfolios. We felt it wasn't appropriate to be overweight going into this year. We brought some more alternative defensive funds in to make it even more defensive. And for the more cautious portfolios, 1 to 3, they're actually underweight equities. But to try and call when the recession will happen is a tricky one. You've got the Federal Reserve. At the beginning of last quarter, they were saying we'll raise rates in December, which they did, and there was going to be 2 or 3 interest rate rises this year, including their tapering of their balance sheet as well, which is tightening monetary policy even further. There's an argument for, on some cases, that the Federal Reserve have already over-tightened, and as we've said before, 10 of the last 13 recessions were caused by the Federal Reserve over-tightening. The other 3, they just survived a recession, but it still was down to the monetary policy over-tightening. So we've got the conditions there that arguably on one side you could say, yes, they've over-tightened and a recession is looming. On the flip side, there's a lot of data out there saying we're still growing, it's tailing off because 2017 was such a great year, so year-on-year data would always look a bit worse than it was, and we are getting towards the end of this current cycle, so there's an argument saying the recession isn't as imminent as many people believe. But we're making sure in our portfolios that we're invested for the long term, and that's making sure the portfolios aren't built on a binary outcome. No, we're definitely not going to have a recession, or yes, we're definitely going to have a recession. Making sure they're built for the long term. Slightly more cautious than we have been in the past. If we do end up with a recession, we've got some really good dry powder to deploy when the markets are even lower. If we don't, we're still going to capture a good chunk of the upside. So we're still looking ahead towards our long to medium term view for the markets.
So clients that are concerned, they've seen their fund values drop. It's been for quite a few months now.
Yep.
They're worried about everything they watch on the news.
Yep.
They're worried about what's going on here, global markets as you alluded to there. How long can you see this downturn in markets continue for? Where do you think we'll be in 12 months' time? 2 questions.
2 questions. It's slightly the flip side of, I don't want to hark back to 2017 all the time, but 2017 and the end of 2016, we had 7 quarters of positive performance, which was great. Every year, nearly 2 years of positive performance, which sort of does then sort of skew people's expectations going forward. They think that potentially might continue. Prior to that, we had back-to-back negative quarters in 2016. So what we've experienced in the past is, in order to capture the upside, you have to accept you're going to have bouts or periods of negative performance. So Q4 being negative, could Q1 be negative? Typically in this market environment, you'd expect it to have a poor January. Typically January is one of the worst months in the year, historically. But going forward, it's a difficult one to call. We need some more data. We need some resolution on Brexit for a start. But if you're looking 5 years ahead, not to be flippant, but this becomes a speed bump more than anything else. But when you're at the coalface at this moment in time, it is massively important. But we're not going to make any knee-jerk reactions either way. You've got a lot of change coming through in Europe. The European Central Bank has just stopped its quantitative easing program and expected to raise rates at some time. And in November, we expect a new head of the European Central Bank as well. Now, we saw a new head of the Central Bank did in the US with the Federal Reserve. It generates uncertainty. So we see Europe as being massively uncertain. That's why we've reduced to an underweight position in Europe. But in 12 months' time, I think there'll be a bit more clarity. I think we'll have clarity politically, because we'll have the European Member of Parliament elections out of the way. There'll be a lot more clarity about Italy at that stage. There'll be clarity over the ECB. And there should be clarity in the US, because this standoff can't last forever. And it's only on one thing, it's only on the wall. They've agreed on every other part apart from the wall. So it just shows you what the next couple of years might be like with the Democrats and the Republicans going head to head. What it has done is massively split the US completely. Before Obama came in, there was pretty much a central ground, but it's been completely separated now. You've got Republicans and Democrats completely separate. We saw that with the highest voter turnout rate for the midterm elections, highest they've had for 30 years. And it literally was, if you're pro-Trump, you're even more pro-Trump than you ever were before. And if you're anti-Trump, you're even more anti-Trump before. There's no middle ground anymore. So by the end of this year, we'll be well into campaigning season for the 2020 elections in the US. We'll probably have a better understanding if we're going to have 4 more years of Trump, or it's going to be someone completely different, whoever it might be. So I think the unfortunate thing is uncertainty is here to stay, and it always has been. It'll be interesting if we draw up a chart for the wall of worry, 2009, 2010, 2011, 2012. Going into 2017, there was loads to worry about, but that's all got outweighed by a fairly buoyant market. We had over 500 meetings last year with fund managers and economists. We've got an extra analyst on our team that joined in December. So we're pushing our resources up to make sure we can take into account every new piece of information that's coming in and make the best long-term decisions for you and your clients. So I'd love to be able to give a simple answer of it's going to be up, whatever. It's going to depend around a lot of the political stuff. It's going to depend around the central banks. Will the Federal Reserve pause and not raise rates? Could they even cut rates? Will we get a resolution with Brexit? Will we get a resolution with the government standoff in the US? However, as that's all going along, there are still some excellent companies still making excellent returns for their shareholders. They are fund managers investing in. So it's an unnerving time, particularly when you look at some of the past where it's been a lot easier. The press love to peddle a negative story, so they've been given the manna from heaven with Brexit and Donald Trump. Goodness knows what they'll do when those two have passed, but it is a case of just sticking to your investment plan. It's probably easier for clients that have invested for 3, 4, 5 years because they're more used to the ups and downs. But if you're a new, exactly. But if you're a new client that's come on board and you are 6 months, a year into your 5, 7, 8 year, 10-year investment plan, it's going to be unnerving because you haven't had the most pleasant experience at the beginning. But I'd say you just have to remember this is a 10-year plan, and the one thing that has shown you throughout history, the longer you spend time in the markets, the better off you are. And we've got charts galore, historically for indices, but also historically for our portfolios. The longer you stay invested, the better chance you have of getting a good long-term return. And also, the time you invest doesn't really make that much of a difference if you invest for a sufficiently long enough period. Probably sounds quaint to say that, but that's what it's shown. So, yeah, incredibly difficult to be robust at these moments in time, but these are the times when you have to stick to your plan. This is where the market's testing you, and in 2 years' time when we look at charts and I'll show you, here's the market testing you to stick to your plan, and when you are up, it's easy to go, oh yes, I would have stayed invested. But when you're looking down the barrel of the gun, these are the moments you have to really trust in the investment plans put in by financial advisors like yourself.
Excellent. Shane, we'll leave it there. Thanks for all your thoughts there. Thanks again for your time. Until next time.
Pleasure, Brian.